All right, let's jump right into a really interesting puzzle in trading, one that honestly trips up a lot of people, even traders who've been around for a while. It's all about how the exact same trades can produce wildly different results.
So think about this for a second. Is it even possible for one person to make a 515% return while someone else, making the exact same trades at the exact same time, only makes 15%? I mean, it sounds kind of crazy, right? But the answer is a definite yes. And figuring out how that works is absolutely key if you're trading futures.
So to get to the bottom of this, we're not going to mess around with hypotheticals or theories. Nope, we're going to look at the actual, real-world trading results from a high-frequency AI strategy. And our case study is a strategy called Agent 2. It's been trading live for the last 6 months, and the results, well, they're pretty incredible, but they also perfectly set up this paradox we're talking about. Okay, first things first, let's look at the absolute numbers, because this is where the truth really is. Over that 6-month period, the strategy made just over $22,000 in profit, and the biggest hit it took, what we call the maximum drawdown, was $1,642. Burn those two numbers into your brain. They are the constant, unchanging part of this whole story. Now here's how the actual live test was set up. It started with $12,500 of capital. After you take out commissions and fees, the net profit was $15,449. That works out to a return of 123.6% in just half a year, with a max drawdown of about 13%. I mean, those are fantastic numbers, right? But believe it or not, this is just one tiny piece of the puzzle.
And now, it's time for the big reveal. We're going to take that exact same dollar profit, that $15,449, and that exact same dollar drawdown, the $1,642, and just see what happens when we change one little thing, the starting capital.
So let's say you're a pretty conservative trader. You decide to fund the account with $100,000. Well, that same $15,449 profit now looks like a very respectable 15.4% return. You would have slept like a baby every single night. Now with the $12,500, which remember was the actual amount used in the test, you get that awesome 123.6% return. We probably call this a balanced, kind of professional way to approach it.
But what if you were feeling a little more aggressive? What if you had started with just $6,000? Well, that same performance would have cranked out a 257% return.
And then, for the extremely aggressive, go-for-broke approach, starting with only $3,000, the return just skyrockets to an unbelievable 515%. Same trades, same dollar profit, completely wildly different returns.
And this slide just shows you the journey perfectly. Look at the 4 charts here. The shape of the line, the equity curve, it's identical in every single one of them. The up and down dollar movements are exactly the same, but the percentage swing, the volatility you would feel as a trader, is just dramatically different. That $3,000 chart is a total roller coaster, while the $100,000 chart is this smooth, gentle climb.
This cable here really just puts it all together. Look across the rows. The net profit in dollars is always $15,449. The max drawdown in dollars is always $1,642. But then look at the percentage rows. As that starting capital gets smaller and smaller, both the return percentage and the drawdown percentage just explode. That incredible 515% return, yeah, that comes with a totally gut-wrenching 55% drawdown.
So, what's going on here? Why does this happen? Well, it's not magic. It all comes down to the mechanics of how leverage works in the world of futures trading.
The whole key is this one concept: futures margin. See, unlike trading stocks, the amount of money you need to control a futures contract is a fixed dollar amount. The exchange sets it. It doesn't matter if you have $10,000 in your account or $10 million. The margin to hold one contract is always the same. And this right here is the light bulb moment for most people. When you trade stocks, you might say, I'm going to risk 1% of my account on this trade. So if you have a bigger account, you take a bigger position. But in futures, the position size is based on that fixed margin. And what that means is the strategy is taking the exact same trades with the exact same position size, generating the same dollar profit or loss, no matter how big your account is.
Okay, so that's the how it works. But what about the so what? What does all this mean for you? Well, it means that when you're deciding how much money to put in your account, you're not just picking a potential return. You are actively choosing your risk profile.
So how do you decide what's right for you? Well, if you're conservative, you'd probably want to put in enough capital so that your maximum expected drawdown is under, say, 5%.
For a more balanced approach, like in the actual test, that 10 to 15% drawdown range might be the sweet spot. But if you go aggressive, you have to be ready mentally for drawdowns of 25, 30, even 50%. And trust me, that is incredibly hard to sit through.
You know, this quote really says it all perfectly. Leverage is a double-edged sword. It's an incredible tool for sure. It amplifies your gains when things are going great, but it also amplifies the pain and the drawdowns when the strategy hits a rough patch.
So, here's the bottom line. The most crucial point to take away from all this is that the amount of capital you choose to trade with isn't just a number, it's a decision. In fact, it's the single most important decision you make because it directly determines your percentage return and, even more importantly, the percentage of risk you are taking on.
So I'll leave you with this thought. The next time you see some strategy advertised with a jaw-dropping 500% return, you'll know that the first question to ask isn't how, it's based on how much starting capital. Because understanding that difference, well, that's the key to becoming a much smarter trader.